Today, we will talk about convertible bonds. A convertible bond is a corporate debt security that yields interest payments but can also be converted into a predetermined number of common stock or equity shares. The conversion from the bond to stock can be done at certain times during the bond's life and is usually at the discretion of the bondholder. The price of a convertible bond is very sensitive to changes in interest rates, the price of the underlying stock, and the issuer's credit rating. Convertible bonds are a flexible financing option for companies. They offer investors a hybrid security, providing features of a bond such as interest payments while also having the opportunity to own the stock. The bond's conversion ratio determines how many shares of stock you can get from converting one bond. The conversion price is the price per share at which a convertible security can be converted into common stock. One version of convertible bonds is known as death spiral debt, which can lead to dilution of shares and drive the price further downward. There are different types of convertible bonds. A vanilla convertible bond allows the investor to choose between holding it until maturity or converting it to stock. Mandatory convertible bonds are required to be converted by the investor at a particular conversion ratio and price level. Reversible convertible bonds give the company the right to convert the bond to equity shares or keep the bond as a fixed income investment until maturity. Issuing convertible bonds can help companies minimize a negative investor sentiment that would surround equity issuance. It can also provide investors with security in the event of default, and offers them a value-added component compared to traditional bonds. However, convertible bonds tend to offer a lower coupon rate or rate of return in exchange for the value of the option to convert the bond into common stock. Companies benefit since they can issue debt at lower interest rates, but not all companies offer convertible bonds, and they are considered riskier than typical fixed-income instruments. As an example, let's say ExxonMobil Corporation issued a convertible bond with a $1,000 face value that pays 4% interest and has a maturity of 10 years. The bond has a convertible ratio of 100 shares for every convertible bond. If the company's shares suddenly spike and are trading at $11 per share, the investor can convert the bond into stock and receive 100 shares, which could be sold in the market for $1,100 in total. Here are 3 key takeaways. 1. A convertible bond pays fixed income interest payments, but can be converted into a predetermined number of common stock shares. 2. The conversion from the bond to stock happens at specific times during the bond's life and is usually at the discretion of the bondholder. 3. A convertible bond offers investors a type of hybrid security that has features of a bond, such as interest payments, while also having the option to own the underlying stock. Hope this would help. Thanks for watching.